Hey guys, so we got to talk about what's going to happen tomorrow, right? The Fed is raising interest rates for the first time in quite a while. And so, yesterday they cut out the mortgage-backed securities and bond buying of 120 billion a month. And so this is big, right? And so now the market will have to support itself on its own, something it has not done in a while, And so if you think about it, and so if you're getting out of this, hit that like and subscribe button, notifications all, really appreciate it. And I'm going to take you through what happens on the first rate hike. Over the last two times we tried this, right? We got to go back almost 20 years to look at this. Look at that one. Look at the one that happened in 2015. See how the market reacts, because this one's different. The one thing about this is we've never actually had a first rate hike and then multiple coming behind it, also at the same time trying to run the balance sheet off, okay? And so that's something we really can't figure into this because we've never done it. And so let's go ahead and take a look. We're going to go back to the early 2000s, after the dot-com bubble. Understand real estate was booming in this time, and the reason why they raised rates was because they needed to cool off the real estate market. It was getting too hot, right? So taking a trip back in time, this is 2004 when they did their first rate hike. And you see it wasn't even that big of a rate hike, right? And you can see major sell-off, but there had to be other factors taking place here, and that's the hard part to figure out, like what is taking place around that rate hike, because that rate hike alone should not push the market down like that, right? You can see the second rate hike sold off, third rate hike sold off. And just kind of looking through, and they did a lot of rate hikes coming through here, right? And obviously this led up to the '08 crash because of a lot of other mess that was taking place, not because of the rate hikes. And so, but you can see, I mean, there's rate hikes right there where the market actually went up, right? And so if we fast forward to 2015 actually, right at the end of 2015, they did their first rate hike. It dropped, popped back up, and then did a major plummet. But there was other things going on in 2016. That's why the market actually sold off, not because of the rate hike. But you can see right off the rate hike, the first rate hike, it sold off. You go through, you got a nice big boom, nice move up here. And it goes all the way to the end of 2016 for when we do the second rate hike. These rate hikes were well divided apart, right? Almost 12 months apart, okay? You can see it sold off a little bit. Then we go on another big major run, get a rate hike, get a sell-off. And so it seems like those first 3 or 4 rate hikes, you seem to get a sell-off for 3 or 4 days, right? And so the important thing to remember here is this is some good information, but what happens after the first rate hike? I just showed you on the charts, right? Well, you can see from 99 to 2015, which is the important ones to me, because why? We had internet, we had a lot more leverage in the market, we had retail investors coming in like never before. You get a negative sell-off after the first rate hike, but when you look the next 3 months, next 6 months, and 12 months, it's obvious to see what's going on here. You get next 3 months are negative, so that's something to keep in mind, right? But then at 6 months starts picking up, and then 12 months we're in the positive, and and so the 12-month rate is 100% positive, right? Never fails. Even go all the way back to 1983. Okay, if you want to go back to those years, I personally don't care about those years because the stock market was totally different pre-internet. It just was, and plus you didn't have all this leverage you have now, and so that's why I like to look at the years from like 2000 up if I can, especially 2010 and up. And keep this in mind. This shows you right here when rates are raised. Same window I showed you, right? But you get a snapshot, like macro view of this, right? 1 to 5.4% is what they did in that time range from like 2004 to 2007. What do you see right here on the SPY, on the SP that is? It went up, right? It was very bumpy. You can see it's very choppy, so it's volatile. But at the end of the day, it went up, right? You look over here. Between 2015 to 2000, around end of 2018. Went from 0.07 to 2.44, which is more realistic to what we're doing now. And what happened? It's as volatile as can be, let me tell you, but it went up. You had some major sell-offs, some major, times you could take advantage of the market, right, and get stocks on discount just like what? Now, right? That's what's happening right now. You look right there, I showed you when it sold off in 2016. You look at the end of 2018, major stock market crash on all indexes. And so, there was a lot of things to take advantage of during that time frame, right? And so I think that's what you really got to keep in mind, that should it be volatile? Sure, history tends to, some way either repeat itself or rhyme. We'll see what happens tomorrow. Obviously, everybody's expecting 0.25%. I don't expect for a second they're going to blow us away at 0.50. And think about it, that's not even a lot, right? That's not even a big interest rate hike. I'm not sure if it's the interest rate hike or the fact they actually stopped the $120 billion in QE every month that really makes a bigger effect on the market. But one thing I'm going to give you a bonus to watch out for. If you want to watch one stock in the market, this stock right here is getting a lot of talk about. A lot of people watching this stock. And I've never seen it where one stock seems to be able to either take the market up or take it down. Like the market's future is in this stock's hands, right? And that is Apple. Like Apple is all over, getting a lot of play today, all over the news channels and stuff, and I'll show you that. But you can see why, basically, is because it's held up pretty decent. But remember, it's probably the most heavily owned stock in all these ETFs and stuff like that. And remember, the FANGs make up such a big weight in the SPY and the NASDAQ, right? Between, if you add Tesla into the FANG stocks, you're talking anywhere from 25 to 30% in the SPY, anywhere from 42 to 48% in the NASDAQ. So you can see when one of those FANG stocks goes down, like Netflix did, it really weighs on the indexes. And this is what everybody's watching for the SPY. If it's going to actually go below 20%, is what happens to Apple. And why? Because it fell below its 200-day moving average. It's approaching the 150-day support level. If it falls below that, there's really not that much support until you get to around 138. And if you don't believe me, you can just watch this guy right here, because I'm not a chart master, but this is what this guy does for a living, and he's pretty good at it. So at least you can hear from him and see what he thinks.
Well, it's very heavy, and we'll look at the charts, but the main thing is this, that this is perhaps the most widely held stock in the planet, and it is really only as of now garden variety in terms of the sell-off. And we'll look at the stats together. Let's look at the first chart. And so what do we know? There are no judgments here except that arrow. I put that arrow in, but it's a well-defined uptrend, and that line connects the COVID low with the sell-off in September, with the sell-off in the beginning of this year. And then here we are. We broke trend almost a week and a half ago. Now, look at the second chart, and where might we go? Well, we're into support. You can see the horizontal line. The peak, of course, was Gen 4, and we're down from actual peak to now 17.92%. That high was 182.94 is all we'll know. So where can we go? It's anybody's guess. Here's mine. Third chart. That peak, that spike that you see there, where the second line is drawn, that was September 2nd of 2020. At that point, Apple was trading some 65% above its 150-day moving average. Compare that to its dot-com peak, it was only about 80%, meaning that was one of the most extended moves on record. I think we'll retrace to that level. That level is 138. And so the final chart, that would represent a 25% decline, were we simply to go back to the September 2nd spike high when it was so very extended above that. Now 25%, we're down, 18 now. Is that garden variety? It actually is. Final table, take a look at this. So this depicts, in summary form, every 15% plus decline in Apple since the financial crisis low in 2009. So there have been 10 instances where the stock sold off 15% or more. And the average decline of those 10 instances, you can see it right there, is negative 30.7. The median is negative 29.4. And here we are down 18 plus. And so why can't it do what it did in 2013? It dropped 45%. 2016, it dropped 33.
And so, looking at that, whenever it falls below 15%, it always goes down farther. I mean, that's pretty scary when you think about it in a way, because if it goes, you can bet the other FANG stocks are going to follow with it. Look at the market, how much it was up today. Pull up the FANG stocks. I get my members to have a watch list to watch. If the stock market is ever up, pull that list of FANG stocks up, because this morning, when we were kind of flat and a little bit up, they were mixed. All of a sudden, now the NASDAQ's up 3%, and you look at the FANG stocks, and they are running, plus Tesla. I include Tesla in the FANG stocks because they need to be a part of it anyway. But, they're up big today, right? And because they have such big market caps, such huge weights in the indices, they can pull the market up and pull the market down. So if Apple drops below that major support level, buckle up, because we might be going down even farther. But if Apple maintains and starts going back into an uptrend, right, and the rest of the FANG stocks start moving with it, boom, we're going up higher. That's the way it is. And we're going to get these, these rips and all that stuff and dips all throughout this market, because it's very volatile. It's not going to be a straight up like, 2020 or anything like that. But that's what you can expect, at least in my opinion, at least in these guys' opinion. And so I at least want to put that out to you so you know what to expect tomorrow. And don't be surprised, because you've seen this before, right? Before Fed meeting, before CPI data, you see these big run-ups, right? Don't forget the VIX is still sitting around 29.30 right now. And then what happens the next day normally? I did a video, what was it, last week when we were going to CPI data. I said, I've seen this movie twice now, and boom, what happened? We run up for 2 days, and then we sold off big time. And so let's see what happens tomorrow, if it's a sell the news event, or if this actually is a bottom, and we're going to start moving, and everybody's, a lot of people are wrong that we're not going lower. We'll see. So let me know in the comments what you think. At least want to put that out there to you so you can take a look at that. And, I'll end up seeing you guys tomorrow with another video I think you'll like. So have a good one. Stay safe.